Good day, participants. Today we would be talking about chapter number 18 of Risk Management and Insurance Planning subject. This chapter is Government Regulation of Insurance. We would be studying about various topics. We would be studying about IRDA, about the Insurance Act, about laws regarding insurance companies in India, about agents and brokers, about doctrine of Weber and Estoppel, about the functions of agent, about the code of conduct and code of professional ethics, etc. Now, if we look at the history of insurance post-liberalization era, in fact, this liberalization had started from 1999 onwards, and in the year 2000, some private companies were set up because of the IRDA Act. But before IRDA Act came into vogue, the government at that time had set up a committee which was known as R.N. Malhotra Committee to recommend suitable measures in order to introduce certain measures in the insurance industry, whether certain kind of liberalization is necessary in the insurance industry, about the status of insurance industry vis-a-vis the insurance industry all over the world, and the amount of insurance penetration in India, etc. So R.N. Malhotra Committee had given its recommendation after several months that yes, there is a need of the liberalization of this industry, because although public sector company which is LIC of India Limited has done a huge work in the field of insurance, and in the field of general insurance, GIC of India Limited has done huge insurances in India, but still the penetration of insurance is still low. At that time they had come out with the figures that the insurance average, that is per capita insurance premium in India, is just $5 as compared to the world's average, which was around $225, and the world average included the developed countries, the developing countries as well as the underdeveloped countries. So the world average was $225 per capita premium, and whereas the Indian per capita premium was hardly $5. So there was a big disparity between these premiums. So they recommended that there is a need to further expand this sector and open this sector to privatization. And they had recommended several other measures in order to develop and in order to grow this industry. So at that point of time, government wanted to bring a bill in the Parliament of India, but because of some political compulsions, because of opposition from some political parties, they were not ready that insurance sector should be open to privatization once again. They said, why then in the first place the nationalization had taken place in the year 1956 and 1973. Then there were a lot of protests by the respective unions of the insurance companies also, the public sector insurance companies also. So after a lot of delays and dilly-dallying, finally government passed a bill which was known as the Interim Insurance Regulatory Authority Bill. And at that point of time, the government had mooted that an insurance regulatory authority would be set up by the government. And so it had also proposed substantial amendments in the Insurance Act in 1938. But this bill could not become an act, but in the meantime the government had changed, and so finally in the year 1999 this bill was reintroduced, but with the changed name. Instead of IRA, that is Insurance Regulatory Authority, its name was changed to Insurance Regulatory and Development Authority. So this act was passed in December 1999, and it was proposed that a separate regulating authority would be set up by the name of IRDA, and this regulating authority would control all the insurance companies in India, whether life insurance companies or general insurance companies. And they had proposed that all the insurance companies will now be controlled by this regulating body, and earlier the controller of insurance used to control used to regulate the insurance sector. So the authority of the controller of insurance was made defunct. Now if we look at the composition of this regulating and development authority, that is IRDA, it was proposed that it will have a chairperson which is currently continuing, like a chairperson. It will have not more than 5 whole-time directors, and it will have not more than 4 part-time members. Not more than 5 whole-time members and not more than 4 part-time members. And all these members as well as the chairperson would be appointed by the central government, and they would be deemed to be public servants under the Indian Penal Code. Now, what are the various functions of IRDA? It's just a regulating body. Besides being a regulatory body, its functions are: number one, to protect the interests of the policyholders insured in the matter of insurance contract with the insurance company. So the basic aim is to protect the policyholders' interest. Then it is not just a regulating authority. So Insurance Regulatory and Development Authority, its function is, its role is also to develop the insurance sector in the country. So its role is also to promote insurance companies, to give them licenses, to promote efficiency in the conduct of insurance business, and to regulate investment of the funds by the insurance companies. So it has to ensure that the insurance companies remain solvent. It also passes any new products launched by the company. It also, any new premiums have to be approved by IRDA. Any other amendments in the products have to be approved by IRDA, and if in case IRDA feels that certain other amendments or certain other corrections have to be done in the product or in the premiums, then that has to be complied by the insurance companies. Then it also has to regulate all the other intermediaries also, besides insurance company, all the agents, the corporate agents, the training institutions which provide the mandatory training. So IRDA has also mandated that all intermediaries will have to undergo a certain number of hours of training, whether in life or in general or in health insurance. And then it also conducts an examination for the intermediaries who will be selling the insurance products, so as to inculcate a sense of professionalism in the industry, and to also ensure that the people who finally sell the insurance plan know about insurance, know about financial products, and are able to provide a professional advice to their clients. Now, the role of IRDA is also to ensure that the Insurance Act 1938 is followed by the industry as a whole. So it has to ensure that the rules, regulations and principles of insurance are adhered to, and it has to ensure that principles like utmost good faith, principle of insurable interest, principle of indemnity are being followed. If we look at the Insurance Act 1938, what does the Insurance Act 1938 says, or what other areas are encompassed under Insurance Act 1938? Number one, Insurance Act specifies about the registration procedures, how the insurance companies will be registered. It also specified about the accounting procedures and the calculation of the returns, the calculation of the reserves and the surplus, and ultimately the calculation about the calculation of the bonus. And it has been made mandatory by the Insurance Act itself that it is mandatory for the insurance companies to get their companies valuated, that there should be an actuarial valuation after the end of every financial year. Then it also specified about the investments to be done by the insurance company, that where the investments have to be done. For example, in the so-called conventional plans, conventional plans means all endowment plans. In the case of life insurance, say endowment plans, whole life plans, term insurance plans, money back plans, etc. The so-called conventional plans, the investments, 90% of the investments have to be done in safe or secured investments. And if the investments have to be done in, say, equity funds or other debt funds or other money market funds, then those type of plans would be different. They would be called as variable insurance plans, or popularly we know them by the name of ULIPs, unit linked insurance plans. Then it has, Insurance Act has also specified limitations on the expenses of management. For example, insurance companies charge premium from their customers. They cannot charge more than a certain specified premium. For example, in the case of life insurance, insurance companies are allowed to charge up to 80 to 85% of the premium in the first year as expenses, because in the very first year of a life insurance policy, the major expenses are towards the sales commissions, towards the medicals, towards underwriting expenses, towards policy issuance expenses, etc. So therefore they are allowed to incur 80 to 85% expenses. Then in the second year, again insurance companies have specified certain limitations. For example, say in second and third year they have specified that not more than 30 to 35% of the premium has to be spent in expenses. Then from fourth year onwards they have specified not more than say 15% of the premium amount has to be spent on expenses, so that the remaining of the fund has to go in the pool of fund and has to be a part of the life fund of the insurance company. Then the Insurance Act again itself has provided for the prohibition of rebates. The insurance intermediary is not allowed to do any rebating in his commissions. Otherwise set a wrong precedent, and also it's wrong selling. It's like giving a bribe to the customer to buy the plan. Then Insurance Act also talks about the powers of investigation. Investigation, it has got two aspects. First of all, in the case of claims, insurers can make any investigation in case of certain claim. For example, in general insurance, we know there are surveyors and loss assessors who investigate the claim. And similarly in life insurance also, if the claim is say within the first 2 years of the commencement of the policy, the insurer can order an inquiry or an investigation into the claim or into the basis of the proposal form. Then the second aspect of investigation is the regulating body can investigate into the accounts, into the returns, into the investments of the insurance companies, so as to ensure that they maintain their solvency and so that there is no kind of mismanagement of the funds of the policyholders. It also talks about licensing of agents. It also talks about licensing of surveyors and loss assessors. It has provided certain mandatory requirements which we had talked about earlier. It also talks about advance payment of premium. We know that premium is always paid in advance. So it has, Insurance Act only has made the provision for that. It also talks about Tariff Advisory Committee, which was there in general insurance, but right now Tariff Advisory Committee has got different role. Previously, because it was a tariff to environment in the general insurance company, so its role was to fix the tariff for the various plans. Now its role is different. Its role is more of to promote the insurance business and to make various surveys in various insurance fields. So basically the regulating body or IRDA's role is to ensure all these things, all these characteristics, all these requirements given in the Insurance Act itself. Now our next topic in this chapter is about the intermediaries, about the agents. Well, we know that in insurance business, it's a large business, is a vast spread out business. So therefore it is not possible for the insurance company to reach the vast customer base directly. So therefore it has to have certain intermediaries who will sell the plans, you can say, designed or manufactured by the insurance companies. Insurance company you can think of as manufacturers, and there has to be some intermediaries. So the basic rule, as we know, of intermediary or an agent, according to the Indian Contract Act 1872, they have defined principal as well as an agent. They have defined that agent is a person who works for, who represents another person to deal with a third person. So who represents another person, this other person is known as principal. The one who is being represented is known as principal, and the person who is representing is known as the agent according to the Indian Contract Act. And the third person is maybe the customer, he could be the client, he could be the third party. Now Insurance Act has got a very wide definition of agent. In normal parlance, we consider agent as the person who just sells, who is an intermediary, who is a in-between person. But Indian Contract Act has a wider definition of agent. It says that the person who is representing the other. In a sense, according to Indian Contract Act, even a lawyer Or an advocate is also an agent because he is representing his client. Client is the principal to deal with the third party. This third party is the court or the judges or the magistrates. So he is dealing with the third party. So he is arguing the case of his principal. So therefore, agent has to be given certain rights by the principal to act on behalf of the principal. Similarly, according to Indian Contract Act, this definition can further be encompassed. It says that even the ambassador of the country, also because he or she represents his or her country to another country, to the third country, so therefore he can also be known as an agent. So therefore agent gets the power from his principal. He gets the authority from the principal. But this authority can be specified. There cannot be unlimited authority. So principal will specify the authority to the agent. Yes, this is your authority. Now this authority can be an explicit authority or this can be an implicit authority. Explicit authority is that which is expressed in the form of a letter, appointment letter, in the form of written or spoken words. Whereas implicit authority or implied authority, we can also call it. Implied authority means the authority which is not given per se in writing or in spoken words, but which is construed from the circumstances. Sometimes there is certain authority which can be understood from the circumstances of the case. So sometimes when the agent is at the spot and the agent has to take a decision, so the agent can revoke his implied authority. So there are various, you can say, connotations to it. Now coming to insurance, in the case of insurance, the section 42 of the Insurance Act 1938 deals with the appointment of agents or intermediaries, and it says that a person can work as an insurance agent only when he or she has obtained a license from the regulating body. And we know that what are the various mandatory conditions by the regulating body in order to become an insurance agent or intermediary. So once again, coming to agent and principal, agent follows the Latin maxim which says that cui facit per alium facit per se. Cui facit per alium facit per se. It means, in English we can translate it as one who acts through others acts to himself. One who acts through others acts to himself. It means that one who is acting on behalf of other, that is the agent. Here one means the agent who is acting through his principal. Sorry, the principal who is acting through his agent. It's the other way around. The principal who is acting through his agent means he acts to himself, as if it should be construed in such a manner that as if the principal himself is dealing with the customer directly. For example, when we buy a car, say from a dealer of Maruti Udyog Limited, so if there is any defect in the car due to workmanship or due to any quality aspect, then Maruti Udyog is responsible for that defect. Although the dealer is acting as an agent, but you cannot exonerate the principal also from its responsibility. So therefore, contracts entered through an agent also have obligations for the principals also. Now, disqualification of the agent, again it says that agent can be disqualified if he is of unsound mind. Agent should not be a minor. He should not be guilty of criminal misappropriation or criminal breach of trust. An agent should not violate the code of conduct, etc. Then the prescribed fees, the agent has to pay the prescribed fee, have to undergo the requisite training and pass the prescribed examination in order to become the agent. Now again, there can be an individual agent, there can be a corporate agent. Corporate companies can become agent. In the case of corporate companies, there would be one person who would be defined as Chief Insurance Executive. We call him CIE. Now this person would represent the insurance business of the corporate agent, and this person has to be an associate from the Insurance Institute of India, at least associate or fellow from the Insurance Institute of India, and other person who would be selling the insurance would be known as the specified persons, and they also have to pass the required examination and undergo the required training. It's 100 hours, but now from November 2007 it's going to be 50 hours for the intermediary. the training, and then they have to pass the examination. Only those people can sell the insurance. In the case of banks, for example, we hear about bancassurance linkages. That is, banks are selling products of insurance companies. In those cases, individual plans can be sold only by the specified persons nominated by the bank. Those employees of the bank have to pass those examinations. They can sell the individual plans. But in the case of group product, there are certain group products like home loan products, auto loan products, and other term insurance products which can be given to the customers along with their saving accounts. So those products, any bank staff can sell those insurance products. So that is allowed by the regulating body. Then there is a provision of a chief agent also, although it's not very much prevalent. There is a concept of chief agent also, a special agent also. But before that, another agent which is quite relevant in the insurance field today is composite agent. Composite agent is the one who can sell both life insurance products as well as general insurance products. That is, he can represent both the company. This is requirement by the regulating body that an agent can represent only one life insurance company at one time or one general insurance company at one time. Or the person who is representing both the companies would be known as the composite agent. So chief agent, there is a provision of chief agent that a chief agent would be a person who can perform any administrative and organizing function for the insurer also, and he would be the person who can appoint other insurance agents in his team. Similarly, there can be a special agent also who gains a special status because of his experience, but the only difference between special agent and chief agent is that special agent will not perform any administrative functions, unlike the chief agent. Now, there is also a provision for brokers. As I said, that agent cannot represent more than one life insurance company at one time or more than one general insurance company at one time. Contrary to this, there is a provision of brokers. Broker can represent n number of insurance companies, any number of life insurance companies or any number of general insurance companies. And brokers, firms arrange to place business of their clients with insurers on the terms that may be standard terms, they can be negotiated terms. But they collect commissions from the insurer to whom the business is placed, and they does not charge the proposer. They are also supposed to give all consultancy services, risk management services to the clients. Mainly we find that brokers are more active in the field of general insurance, in the case of business houses, in the case of industries. They offer them various risk management procedures. They provide them advice that which of their objects have to be insured, by what amount, what type of insurance they can take, and in turn they can also negotiate the terms and conditions with the insurance company. Now there is a provision by the regulating body that there can be three types of brokers. Number one is direct broker, number two reinsurance broker, and number three is composite broker. Direct broker. In the case of brokers, direct broker is the person who can sell either life insurance products or general insurance products of any company to the customers directly, and he can act as an intermediary between any insurance company and the customer. So he can offer different products of the insurance company, and he can suggest, and ultimately the customer can choose among the product which suits to his requirements. Then reinsurance brokers are those brokers who do only reinsurance, who license with reinsurance companies to give reinsurances to the insurance companies. And composite brokers are those brokers who also sells directly to the customers and who also provides reinsurance to the insurance companies. There is a requirement for capital for brokers also. It's not easy for an individual like myself or any other person to become a broker, because there is an investment required. For the direct broker, an investment of 50 lakhs is required. That is the minimum amount of capital has to be maintained by the direct broker. And for a reinsurance broker, the minimum, you can say, paid up capital kind of thing is 2 crores, and for composite broker it is 2.5 crores. Now there is a very important doctrine of waiver and doctrine of estoppel. What is the doctrine of waiver? Doctrine of waiver, W-A-I-V-E-R, it's defined as the voluntary relinquishment of a known legal right. It means that if the insurer has voluntarily waived a legal right under the contract, so the insurance company cannot later deny payment of a claim to the insured on the ground that such a legal right was violated. For example, if a proposer has sent a proposal form to the insurance company, signing the declaration and filling up the form, and in case if he has left certain entries unfilled. So, for example, the proposal is accepted, the policy is issued, say after 1 year or 2 years, if any claim arises, then the insurance company cannot use the claim that such and such entries were unfilled in the proposal form, because it says that at the very outset it should have rejected the proposal form and should have reverted back to the proposer that to fill up those entries. So therefore, the doctrine of waiver would apply in this case, that it cannot now refuse the claim, because earlier it would be considered as it had voluntarily waived off that condition to fill up those entries. So this is the meaning of doctrine of waiver. Now we come to the second doctrine, which is the doctrine of estoppel, E-S-T-O-P-P-E-R. This doctrine prevents a person from denying the truth of a previous representation of the fact, especially when such representation has been relied on by the one to whom the statement was made. It is basically designed to prevent persons from changing their minds to the detriment of another party. To understand this, let's take an example. For example, a policy holder had inquired from his insurance company that my premium is going to be due, my next premium is going to be due, when is my next due date? For example, the insurance company, some official of the insurance company answers that there is a grace period of, say, there is still a grace period of, say, 15 days, so therefore you need not worry, and then you can pay the premium after 15 days, you have a grace period. In case a claim arises within that intervening period, now the insurance company cannot refuse the claim that there was no grace period, you should have deposited the claim, because it is said that policyholder relied upon the statement of the official of the insurance company. So therefore, now it cannot refuse the claim. It cannot go back on its own representation. So therefore, this is called the doctrine of estoppel. So I hope students, you would have understood the concepts, and please read it and study it thoroughly, and best of luck. Thank you.